JPX energy market weekly updates. The supply-side news is a major factor in market volatility last week. Market started the week under pressure following a report in the Wall Street Journal suggesting that Saudi Arabia was set to propose a 500,000 barrels per day output increase when OPEC meets in early December, which at one point sent crude prices tumbling 5%. However, oil prices finished lower Friday after the European Union discussed a price cap on Russian oil between $65 to $70 a barrel, a higher price range than the market expected, and at levels that reduce the risk of disruptions of European Union sanctions on Russian oil shipments. Much hinges on two huge unknowns: the degree to which Russian supply will come off the market after sanctions kick in on December 5th, and the impact of the company in G7 price cap, and when and how quickly China's demand will recover. Russian Urals crude is currently available at discounts around $20 a barrel to dated Brent, which at current levels puts the Russian grade firmly within the $65 to $70 range. And the higher price would keep the Russian output close to current levels and add to the flows of Urals already heading to Asia. The idea of the price cap is to prohibit shipping, insurance, and reinsurance companies from handling cargoes of Russian crude around the globe, unless it's sold for less than the price set by the Group of Seven Nations and its allies. No final decision has been taken by the G7 and the European Union yet, though talks are expected to continue this week. Saudi Arabia and Iraq have reiterated the importance of adhering to OPEC+ output cuts that last until the end of 2023, according to a statement. The statement also pointed to the ability to take further measures if required to achieve balance and stability in the market. However, all market watchers confused over signals on OPEC's next policy move or found little clarity in fundamentals. With the International Energy Agency, OPEC's analytical arm, and the Energy Information Administration at odds over supply requirements for the first quarter of next year. EIA sees need for OPEC to pump more oil in the first half of next year, with the IEA and OPEC Secretariat suggesting little scope for an increase. While U.S. pressure is deemed as big challenge to a further cut, the mixed data on oil balances suggests for now, maintaining the status quo may be the preferred course of action. China's rising COVID cases and return of restrictions have weighed on oil prices as the market fears another slowdown in China's economic growth and fuel demand, on top of global recession fears. Lockdowns in China are bad news for more than just oil bulls, because its role as global supplier, any large-scale disruption in Chinese economic and industrial activity means lower supply of often crucial products. On Friday, in an attempt to shore up the economy, China's central bank slashed the amount of cash lenders are required to hold in reserve by 25 basis points for the second time of this year. Dubai lost further ground to its Brent counterpart as the Brent and Dubai cash spread at one point widened to over $7 a barrel before crunching back to $5 a barrel on Friday. Market structure has also softened as attention in the market turns to near-term oversupply. The prompt Dubai market structure remained under strong downward pressure as the first month and third month Dubai spread set a yearly low of 85 cents a dollar on Thursday before rebounding to close the week around $1.50 a barrel. Furthermore, Dubai spreads for the first half of 2023 crashed into contango, with the first 5 intermonth spread of the new year showing a negative structure on Thursday. In the product market, diesel cracks eased since early November from the record highs in the month before, as supply shortages in Europe due to the strike actions were resolved. Product exports from China rose, and slowing economic activity continued to depress demand. Prompt gas oil cracks again fell below $39 by the week's close, hovering near 2-month lows. Backwardation also came under pressure. Gas oil contract from May onwards firmed, with a 6-month forward backwardation narrowing to a 2-month low. However, finding new markets for Russian diesel may prove more difficult than crude, with bottlenecks in clean tanker markets a particular problem. OPEC market management and risk around Russian oil supply will likely provide support in the short term, but strong microeconomic headwinds will cap any immediate upside. The end of COVID lockdowns in China and the loss of Russian supply after sanctions take full effect, as well as increased jet fuel demand, should see markets reach balance and ultimately undersupply by the second half of next year. Okay, that's all we have for this week. Welcome back next week.